ভিডিও ক্যাপচার নিয়ে কিছু কথা না বললি না, যেখানে টেস্ট ওয়াইড গেট নামে একটা বাটন আছে। সো টেস্ট ওয়াইড গেট বাটনে যদি আপনি চাপ দেন তাহলে দেখতে পাবেন যে এখানে কিভাবে আপনি ভিডিওটা রেকর্ড করতে পারেন, সেটা নিয়ে আপনি কথা বলতে পারবেন। ওকে, so now second thing we're gonna talk about today. So we're gonna go far so good. We're gonna go a lot of things today. So let's see how you're gonna remember everything. Okay, so let's say as an example, we have put it there like $800,000 property. So let change this number. Let's say it's a $650,000 property. For an example, let's say the interest rate will be 3.2, and the 30 years term, which is like for 30 years. And let's say the taxes for the single family in the branch, we can say $450, and the insurance we could say like $100. So that will be the number. So now if you take a look at it, all the numbers, so when you put like less than 20% down payment, there will be the private mortgage insurance or PMI. So now all this you can see in this chart that there is a lot of option here, like say, like let's say the conventional 5% down, conventional with 10% down. You could say like FHA with 3.5% down, conventional with 20% down, FHA with 20% down. What is the difference between the FHA 20% down versus the conventional 20% down? We have conventional with 25% down, conventional with 15% or 15% down. So now, if you ask me a question, the what is happening, like there is a lot of program, but you are just talking about only the conventional FHA in the New York State. The reason why I'm doing so, because in the New York State you cannot like say that you can get a USDA loan or the BA loan, because the BA loan is only for the veteran, which means you have to have work for you are working for the United States Army, Air Force, or the Navy. Only on that case you will be qualified for the BA loan. Or the USDA, Department of Agriculture, which is United States Department of Agriculture loan, only those property are qualified under the USDA loan, only then you can get the USDA loan. So which basically in the New York State is not, we cannot find any qualified property in the New York State. So that is the reason we are not spending our time for this type of loan. So now, next let's see the what is happening, like if you buy something with a single family with the 5% down payment. So on that case, you see that the payment will be $3,405 based on the value we said, like $650,000 with 3.2% interest rate, $450 monthly tax, and the $100 insurance. So the reason is saying that if you pay 5% down payment, on that case you have to pay private mortgage insurance, which is not that much expensive. Is maybe our estimating, if your credit score is good, let's say medium level of credit score, on that case maybe you have to pay extra $185.25. So your principal and interest will be $2,670, and the principal and PMI will be $185.25, and your tax and insurance altogether maybe $550. So your payment will be $3,405. So that is the last thing you want to see that. So what if like if you pay 20% conventional down, on that case you don't have to pay like PMI or private mortgage insurance. On that case your payment will be 27,000 up sorry $2,798.83. So it's very clear and nice thing that you can see here the different product whichever you like to get it, or like whatever product you are qualified for. It's not about like that what I like, it is about that what you really qualified. So let's say you want to buy something like conventional 20% down, but you don't have the money. So in that case, like so you cannot say this is what I like, so this is what I qualify for. So that is the best option, 2798. So what if the interest rate we change? Let's say 3.2. For an example, we put 2.8 interest rate. So in that case, if I pay 25 or 25 or 20% down payment, what will be my payment? So look at this, the number. So 2686, which will be the payment. On that case, your principal and interest will be 2136, tax 450, insurance $100. So you are paying as down payment $130,000 based on the price whatever we put. So now let's say we're gonna put something like $600,000. So now let's see what is the difference come up. Like look at this. Now it's saying like only $2,522.29. So now if you say house hacking, what it mean by house hacking? First of all, house hacking means something that if you get like enough rent to cover your mortgage, on that case we can say this is we call house hacking in the real estate industry. So if you get like let's say you are having like one unit rent like $1,800, and you have another like it's not illegal, but it's everybody is doing that more basement rent. So on that case you are getting $700 from there. So Now you have set $2,700 income, but your mortgage is 2522, which is like we call it house hacking. So so you don't have to pay anything from your pocket. So but remember, on that case, the property must have to have like it's a big building, like it's three level of building, where one level you can stay, another level you can rent, and the downstairs, I mean the basement, you can get something else. So that is how all scenario about the conversion at 20% down. What if like you are paying only 5% down payment of the same property? Everything will be the same. Your payment will be $3,000, which will be the only for the let's say your private mortgage insurance will be another $171, and principal and interest everything together will be $2,342. And for an example, tax and insurance will be same. So this is what we are like. So now look at this. The way we are saying that everything will be pretty much straightforward, everything else is good, is not like I told you before that what I qualify, what I like in the real estate industry or mortgage industry is not something that way. So you have to have qualified for this thing. So like a lot of time people said like I make $150,000, I make $160,000, so I'm qualified for the $1.2 million property, but in reality is not, because it's not about only the income what you have, but it's a lot of things we have to see. We have to see your credit score. We have to see the property you want to buy. That property isn't qualified. The appraisal value will be the good. Let's say the property is really good condition. There is no C5C6 issue. There is no like you have enough down payment to cover the property. Like for a conventional loan, for an example, let's say the conventional loan. So let's say two or three family, four families. So if you buy something with a single family, there is no minimum that you have to have. So most likely to be most lender go by the 5% down payment. But yes, you have the option. You have the option like home ready or home possible with the 3% down payment. But if you buy something, the conventional loan, let's say is two family, on that case you have to pay minimum 15% of down payment. If you buy something with three or four family, on that case you have to pay minimum 25% of the down payment of that property. So it means you have to have money in order to qualify that property. Second thing, I would like to focus on that video specifically. Let's say you're gonna go for the FHA loan. So a lot of people talk about like you can buy something with a 3.5% down payment FHA, which is true, but there is other scenario you have to think about it. Like let's say you want to buy something with a single family. On that case, yes, it's gonna be good for everything. But if you buy something, what if like you buy something three or four family with the FHA loan? What happened on that case? On that case, every time you think about the FHA loan, they are care about your property, not you. What I mean by that, they also care about your income, asset, and everything, but most likely to be they go by the property, what how the property is qualified, and then they will come to you. So which is like in two different way you have to qualify. Most likely to be they will give the pressure the property side. Let's say the property have to have like self sufficiency, which is mean like the property rental income versus the mortgage, PIT, and everything must be less than the rental income. So they give you like 75% of this, so that way like the property must be qualified in order to get the FHA loan. Also you have to be qualifying the income side. So more or less we can say that they look at like a little bit they are more lenient. People say they are more lenient. Yes, it is right, but what is the lenient mean? So let's say your income in some reason is like the DTI is short by 1%, which is mean like you're qualified for $450,000, but in some reason your income is qualifying for 34, like so 440, so it's $10,000 short. On that case, the conventional people will not qualify you, but on that case, FHA might qualify you. So that is like more lenient. It means like they want to take a look at it more. The people, sorry, more the property than the people. This is what is the basic difference: the FHA versus the conventional. Now, if you take anything else like the conventional loan, what happened? They're gonna take a look more likely to be the borrower and less likely to be the property. So that is the really good thing that people go by the conventional loan. There is then the private mortgage insurance is just some bucks. What I mean by that? Let's say your credit score is 750 to borrower. So on that case, maybe you have to pay another 120 bucks or like $120 or $110 extra because you're not paying 20% down payment. So the conventional is always best, and we go by the